want to bring in Federated Investors, Chief Equity Strategist right now, Phil Orlando. And Phil, it is good to see you. Thank you so much for joining us.
Thanks for having me back.
You've been right on the money on this market. You think the momentum is still there to continue?
We still have a 3,000 forecast in 2019. We've seen nothing to come off that number.
Wow. Okay, so the backdrop was pretty good, but we got a jobs number out today that's going to get hit with hurricane damage, with the effects of what we saw in Texas, in Florida. Is that a temporary thing?
It's absolutely a temporary thing. So we've got an 85K estimate for today. Most folks are in the 80 to 90K neighborhood, so it's going to be a sloppy number. That's, half of where we were earlier in the year. So to understand that, there are two key inputs in the model. You look at the ADP numbers, you look at the claims numbers. The ADP numbers at 135K for September, down about 100K from the prior month. The claims data before the storms was at a 40-year low, down around 230,000. That number spiked to about 300,000 right after the storms. We've now come back down to 260,000 for the survey week for September. So we're starting to improve, but there will be a transitory impact on today's number.
How high does the number have to get, Phil, for this to be considered a good number? Anything north of 100,000, or is it something higher than that? What's a good number look like this?
So if you look at the full range of Wall Street forecasts, you got some folks who actually are looking for a loss of jobs. Some folks that are looking for gains over 100K. So I would say that I think your 100K estimate is a good one. If we can actually add jobs at that level and sort of slough off, sort of the near-term impact, then I think the street would be excited about that number.
Yeah, and the other thing that I know we need to look at in this report certainly is wages. We've spent a lot of time talking about that and really haven't seen the wages move. We did see household incomes go up from the last report. What do you think about wages? What do you think is going to happen?
So I agree with you that we want to see wages move up to that 4% neighborhood as well. We've been sort of stuck at that 2.5% neighborhood. Now, specifically with this month, we've got another wonky phenomenon that in terms of people that might have been temporarily displaced, it's probably going to be hourly workers.
Yes.
As opposed to permanent workers. So that may sort of change the mix such that the folks that are actually employed, you may see that number perk up a little bit, but it's only because you've sort of lost the low end, at least temporarily.
Wait,
yes.
But do you really want to see 4% wages? I know that we want that for the American people, but as a stock investor, as a bond investor, higher wage inflation could mean significantly higher long-term interest rates, or certainly north of 2.5% on the 10-year yield. That potentially could throw cold water on the stock market rally. So do you really want 4% wage growth versus, say, a more muted 2.5% to 3%?
Well, that's a great question. It's all about timing and pace. We absolutely expect to see a 4% number, but not until the end of 2018 at the earliest. So it's going to take us another year and a half to get there. The Fed would love to see core inflation at the 2% or higher neighborhood. We're sitting down here at 1.4%. And Yellen's pulling her hair out because she's now saying it's a mystery. We at the Fed have no idea why inflation is as low as it is. So we'd love to see a little bit more inflation, but work into the markets, the economy, the bond market, particularly at a slower pace, not a rapid pace.
Meanwhile, this market just will not quit. The president tweeted about it yesterday, about this incredible gain in the market. Stock market hits an all-time high, he says. Unemployment lowest in 16 years. Business and manufacturing enthusiasm at highest level in decades. So how do you allocate capital now, Phil? Okay, we know that the Dow, the NASDAQ, and the S&P all hit all-time highs again yesterday, and we're talking about almost $5 trillion in market value.
Sure.
Are there areas that have not gained? Are there areas that have been missed that maybe there's still value left here?
So we're still 5% overweight equities in our overall allocation model. There have been two recent developments that are probably worth talking about. One is the rotation from growth stocks to value stocks. That started maybe about 5 or 6 weeks ago. Financials, industrials, energy stocks are starting to catch a bid. Those stocks dramatically underperformed earlier in the year. The second thing is with the tax cut proposals, as well as the recent strength in the dollar, small cap stocks are starting to catch a bid for the first time in a really long time as well. So what we're telling our clients is new money should go into small cap and the value stocks.
Okay.
How much of a difference does the corporate tax cut make next year for earnings and for stock market valuations? I've heard big things, actually, 7 to 10% earnings boost if this thing goes through. Do you see that?
Absolutely. It's a question of timing, though. This may take a little longer than we thought. So we'd love to see...
Oh, you think?
You think? We'd love to see that get drafted by the end of the year and maybe get passed by the end of the first quarter of next year. So we're thinking in terms of what might the 2019 full impact look like. So we've got a $150 estimate on S&P earnings for 2019 right now, just based upon fundamentals. The leverage is that for every 1 percentage point decline in the federal tax rate, you could add $1.30 to earnings. So theoretically, if we can cut the taxes at the federal level down from, say, 35% to 20 or 25%, that might add, $10 or $15 a year to earnings. So that $150 number could look like $160 or $165 in 2019.
Yeah, well, that's really the earnings story and the impact. That's why the small cap stocks are getting a bid, because it's small and mid cap companies that are really going to get a huge positive from this. If you're talking about a rate that goes from the individual highest of 39.6 all the way down to 25%, that's a big deal for the small cap companies.
The taxes and the currency are the two big drivers there.
All right, we'll leave it there. Phil, great to see you.
Maria, thank you very much.
Thank you so much. Phil Orlando joining us there. Be sure to